Cardano looks very dangerous right now. Look at this downward trend on the relative valuation of Cardano to Bitcoin. So this is Cardano in Bitcoin, not in US dollars, and we are in a pretty clear bearish trend with multiple confirmations on both sides. Now from top, the end of August 2021 to the current price, Cardano underperformed Bitcoin by roughly 75%. Within that trend, we are quite high as well. We could easily see a drop of another 40% or so relatively quickly. Now, this is actually not the main reason why I am concerned about Cardano. The main reason are those two lines over here, the turquoise line and the red line. The price is below both of those lines. Those are moving averages, back-tested moving averages. So when you trade according to a moving average, you want to find out what's the best kind of a duration. So let's just draw a random moving average here, double click on that and set the duration. So for example, to 30 days. You see how now this line is way closer to the price, right? When it's longer in duration, it's further away. So going back again to 100, you see the line isn't as close to the price. Now, one idea to kind of catch these waves and to be in the market when times are bullish and to be out of the market when times are bearish is to buy whenever the price crosses from below the SMA to above, to sell whenever the price goes from above to below. There are some failed signals here, right? So you would have sold here just in order to then buy back again slightly higher. This happened here again. And the same is true the other way around, right? You would have bought just in order to then sell again when it drops. But this is a relatively solid trend following strategy. The only question is, what's the best duration for that moving average? What duration generates the best signals, especially on the short to medium term time frame, right? Should we take the 25-day? Should we take the 50-day? Should we take the 7-day? And if we follow such a strategy, how well does this even work? The reason why I show you all of this is because the strategy does work quite nicely. So look at this. This is the outperformance using the 20-day simple moving average. In white, we can see the Cardano price. It's basically a horizontal line because even after trading fees, the outperformance here is massive. This is the result if you trade it according to that 20-day simple moving average. Now, because we can't see the price of Cardano on this linear scale, let's switch this to a logarithmic scale. And that's what we get. Okay, so this is the price of Cardano in white. And again, in turquoise, the back-tested performance. And we can see even when the price goes down, sometimes our portfolio line here goes up. That's because we are shorting whenever the price is below the moving average, right? So we either bet on rising prices or on falling prices. We look at the price at the end of day UTC, and just based on that, once per day we check, we either go long or we go short. Trading fees are 0.2% for each trade. See how constantly this outperforms. And one horizontal line over here is a 10x difference, right? So this here is not just 10x, not just 100x, it's almost 1000x of a difference in terms of performance. And that's why we can't see the Cardano price properly on this linear scale. It's simply outperforming that massively by 1000x. So the strategy really seems to be working pretty well. This is the 20-day SMA in turquoise over here, and we are below the moving average. Note, we do get our failed signals sometimes, right? So this is by no means a perfect strategy, and we don't always outperform, right? Look at, for example, this time here, the first half of 2021, our portfolio line actually went down, whereas Cardano went pretty much sideways. Still, it is a backtested strategy that works quite nicely. In red, we've got the best exponential moving average. So that's the line for the best EMA. It has a bit less volatility. So note how here we get this drop in the portfolio quite a bit. Don't have that drop that massively in the EMA. For the best EMA, 39 days turns out to be the best. So a summary of all of those backtests are in this chart. Again, in turquoise, the simple moving average, and in red, the exponential moving average. And on the x-axis, the duration of the moving average in days. So over here at 20, we see this is the best simple moving average, which gives us more than 800% per annum. So this is annualized performance. And for the EMA, we are here at 39. Pretty much similar performance with the SMA slightly outperforming, which kind of makes sense because you react more to the market. You're a bit closer to the price. You have to trade a little bit more. And this additional trading hopefully also gets compensated to a degree. What I like about the strategy is that it tends to work in two dimensions pretty well. The first dimension is consistency over time, right? We tend to outperform relatively consistently no matter if we are in a bear market or in a bull market. That's good, right? You want to get your outperformance not just in certain markets, but all the time. The second thing I like about the strategy is that no matter what kind of a moving average duration you take here, you tend to outperform buying and holding quite steeply. So buying and holding as a comparison is here in black, the hodl line, very, very low. So if you use a moving average that's only 4 days in duration, you already tend to outperform just buying and holding. You have to go a bit longer in duration in order to make this really worthwhile because a lot of trading fees occur on those very low durations. When we look at one, this simply just means looking at yesterday's price, so we're not really averaging out anything. But yeah, once you go above 15 days or so, we are pretty much in a very healthy outperformance range compared to buying and holding. And this is great. This means we tend to make money over time, but it also means if we don't get the moving average perfect, and it's in the end, in the next year or two, not the 20-day SMA or not the 39-day EMA, but it's instead, say, the 35-day EMA, it shouldn't matter that much because the performance across parameters isn't too different. It isn't fluctuating too much. And so that's why I'm mainly concerned, at least over the next few weeks, about Cardano. Currently, it's not bullish. Basically, since the 23rd of February or so, it's not bullish, right? That's when we crossed the SMA. 1 or 2 days later, we crossed the EMA. So we have fallen since then already by 11%. And the backtest suggests that this is likely going to continue.